Well, the human toll is horrendous, and the full carnage from Japan's earthquake is as yet unknown. Tokyo's stock market bore the brunt of the financial market reaction to the disaster in Japan. As we heard, the Nikkei index dived more than 6% as investors hit the country's biggest manufacturers like Toyota, Nissan and Sony, as well as insurers and power companies. The Bank of Japan moved quickly, injecting a record 15 trillion yen into money markets to help free up the financial system. Here's Philip Lasker.
In terms of economics, policymakers and Japan's central bank are doing the only thing they can.
The Bank of Japan will do its best to ensure stability of the financial markets and supply adequate liquidity. Rest assured that the central bank and commercial banks will work together to provide enough cash.
So far, that's more than $180 billion from Japan's central bank and billions more from the government.
Over the next couple of days, we will get the Japanese government coming out with a supplementary budget. Now, the rating agencies may not like that.
That's because Japan's government is already sitting on a mountain of debt, but with interest rates zero, it can't do much else. Pouring money into the system didn't stop Japan's stock market from diving more than 6% as investors worried about a different nuclear fallout.
If Japan is to lose relatively permanently, say for as long as 1 year, say 10-20% of our power generations, I think that would be severely negative for the economy.
Stocks like Tokyo Electric Power saw sell orders outnumber buy orders by 200 to 1, and no trades were made.
The nuclear sector is almost shut down. We've had gas pipelines in trouble. So really that's the first point of order for the Japanese authorities.
And that's one of the reasons analysts suspect Japan may take longer to recover from this earthquake than the Kobe quake in 1995.
This time round it may take a couple of quarters before we start to see the reconstruction adding to GDP growth down the track.
The yen surged due to its safe haven status and because Japanese companies like insurers were bringing money back home to deal with the massive payouts they may face. But the country doesn't need a strong yen.
It could compound the problem, so that's where they'll be taking steps to ensure that if that goes too far, that they try to reverse it. And one way of doing that is to make sure that the system's really liquid.
Whether this crisis triggers the type of tax and industry reforms Japan needs to reduce debt and grow efficiently remains to be seen. But there may be some policy positives.
There's been, for quite a long time now, tension between fiscal and monetary policy. So this might be the beginning of an ability to work those two policy tools in a more consistent way together towards the same objective, instead of having one pulling towards fighting inflation and the other pushing towards increasing growth. For now, you might get a consensus that restoring growth is what matters.
Hopefully that consensus will last beyond the immediate task of resurrecting the economy.